All right, so we'll jump right in and get things started. So, once again, thank you everyone for taking some time out of your day today to join us here on our webinar. Today, what we're going to be doing is we're going to be taking a look at the world of manufactured homes. Now, biggest thing I want to start off with here, let's set the level of exactly what we're going to be talking about. A manufactured home is not the same thing as a mobile home or even a modular home. So, a manufactured home at the end of the day is a factory built home that is designed for year round living and built to specific HUD standards. Now, the thing about manufactured homes is that they make up about 10% of all the housing market across the entire United States. So, 10% is pretty big for considering we're talking about all 50 states. So this is something, and these are home property types, they're going to come up often. If you haven't already worked on a manufactured home prior to today's call, or if you have worked with manufactured homes before, we're going to touch on all the things you need to know to kind of get started into that world of this property type. I'm going to throw a lot of information at you. We have a lot of slides, a lot of information that is part of our presentation. But even with a lot of that information we're going to talk about, the biggest takeaway I want to kind of jump into here is not to be afraid of this property type. A lot of people are afraid of manufactured homes and everything that's attached to them. The great thing that I'm going to show you today is that it's pretty straightforward and a great property type to get into, and a great opportunity to, if you have borrowers that are wanting to work with you that are looking to either purchase a manufactured home or do a refinance on their existing manufactured home, there's just some simple things you need to keep an eye out for to make sure you have those transactions go through as smoothly as possible from beginning to end. If you have any questions as we're making our way through the presentation, feel free to throw those questions into the chat box that is here on Zoom. I'll be happy to circle back around to those questions as they come in. But of course, we'll leave a little bit of time at the end of the presentation today to open it up if you want to throw questions once again in the chat box, or you can even unmute yourself at the end, and I'll be willing to stick around for a few minutes and answer those questions once we've gone through all the slides we have to present today. So let's jump right into things and talk about the world of manufactured homes. So the first thing to get started here is, what is a manufactured home? So what is it at the end of the day? So here on this slide, we have what we call the physical DNA of a manufactured home. So first thing here, it's built on a permanent steel chassis. It has been permanently affixed to the foundation that it's located on, and it's meant to be lived in the same as any type of traditional home. So it's built as a year-round living type of situation. Now, if one of these elements are missing, that is something that will change it from being real property to being considered a personal property. That's the biggest piece here, is that manufactured homes are considered real property. So they're the same as a traditional site-built home, for example, is real property. Now, in your mobile home situation, a mobile home is not considered real property. It's considered personal property. So that's why those are not eligible for manufactured home financing because they're personal property. That's where those eligibility problems begin. So that's why you want to make sure we have that. So once again, biggest thing here, it's been built in a factory, designed to be lived in year round. It's built to the standards that HUD developed in 1976. It's constructed on a permanent steel chassis that is permanently affixed to the foundation with no wheels, no axles as well. And I mentioned earlier that these types of homes represent over 10% of the stock of homes across the entire United States. So great opportunities available there. Now, some things to keep in mind here that must be met when it comes to a manufactured home. I mentioned just a few moments ago that those HUD standards were developed in 1976. So specifically June 15th of 1976. So all manufactured homes must have been built on or after that 1976 date. At this point, most homes across the country are going to fit within that bucket there, because that was coming up now on over almost 50 years ago, coming up pretty soon here. So we have that. Big piece here, it must be classified and taxed as real property. So fee simple, real property in order for it to be considered eligible for manufactured home financing. Permanently affixed to the foundation on the original chassis on what it was built in the factory, whenever that date was. It must meet all of your flood elevation requirements, which is a topic we'll talk about a little bit later as well. And the HUD certification labels must be accessible depending on how many sections the home fits into. So you can see there's your single wides, which just as the name entails, is just one piece. Double wide, which is two pieces combined together, and then a triple wide, three pieces combined together, and so forth. There are some manufactured homes out there that are more than three, but typically they don't get any larger than three sections kind of combined together. Most manufactured homes you're going to come across, most of them are typically double wide. I would say the majority are double wide out there, but you have your single wides and your triples, and so forth, out there as well. Some people do have that. So that is kind of the biggest piece. You can see these check marks here on the screen. This is what I consider your pre-application checklist. These are your boxes that you need to meet in order to, when you're having your conversation with your borrowers, check these off and say, okay, ask them these questions. Does it fit this? Does it fit this? Does it fit this? Fit this? If one of those things is missing, that's where we're going to probably run into some problems. And what before you get too far ahead of yourself, you can always reach out to our team here, reach out to your account executive, reach out to our scenario desk that we have, run it past us, and get some a little bit additional insight before we get too far ahead of the process. So this is just kind of giving you a nice little tool here to check off, okay, I had a conversation with my borrower. They all of these items, we checked it off green. We're good to go. That means the property that they're either purchasing or refinancing is good to go. That's something that is eligible for us to move from there. Catching this and making sure you have that saves everybody from that stress that's going to come later in the process when we find out, okay, unfortunately, we can't use this property. We don't have any programs for it. So it's the biggest thing to kind of really get your best foot forward. Now, speaking about eligibility, so things that are not eligible, so anything that's located in a park or a leasehold estate. We mentioned there that the property has to be owned by the borrower, real property. So they own the home and the land combined in fee simple. Those are the only types of properties eligible. A park or a leasehold estate, those would not be eligible under these programs. Now, typically, condominium projects are not acceptable across the board. The only exception to that is if it's an FHA HRAP approved condominium project. So FHA HRAP approved, the entire community has to be FHA approved. It's not a single unit thing. It's a whole community has to be FHA approved, and that's the only way to do condominiums with manufactured homes. Any type of unit that's been moved or traded, with the exception of VA. What that means is that I put I built the home in the factory in 2003. The home was built on in the factory. It was placed on site A in 2003. In 2010, the borrower moved the home from site A to site B. The process of moving that home from the first place to the second place automatically disqualifies it from every agency except for VA. VA is the only agency that allows for a property to be moved one time uh, in order for them to still get financing for a manufactured home. So that's a big question to ask too. Has that home ever been moved at any point in its life? Because conventional, FHA, USDA, it in order to get financing, it must be on the same property that it was put on after it came out of the factory. So that's a big one to keep track there. Any type of unit that's been not been permanently affixed to the foundation, not acceptable. And of course, we mentioned earlier that anything that's considered personal property is not acceptable under these particular guidelines. So biggest thing here is that don't assume that a manufactured home is the same thing across the board. Always ask your questions first. go through kind of that due diligence up front, and that will save you from the headaches and stress that come up later on, which is why most people have kind of negative connotations with manufactured homes, is because they run into these kind of roadblocks and hard stops later in the process that cause a lot of headaches because there wasn't that research and due diligence done up front that saves you from all that. Because once you've got all that stuff clear, the rest of the process is pretty straightforward, as you would be with any other transaction. Some other things to call out here, the difference between what's considered a new and an existing manufactured home. Some agencies kind of call out specifically in their guidelines the difference between those two. This applies across all agencies. So this applies Fannie, Freddie, FHA, USDA, VA, all of them. Is this type of explanation of those differences? So new is anything that's less than a year old. So anything less than 12 months is automatically considered to be new. So those are types of properties they may need some additional site work, or they may need to be attached to the utilities. Very possible. But the home itself and the foundation is 100% complete, but it's just less than a year old and might need some uh, specific work, let's say landscaping work, or it hasn't been attached to the power pole yet. Is possible. An existing home is a home that is fully complete, fully functional. It's been existing for more than a year. So let's say it's 10 years old. It has all of its utilities. It has everything's fully operational. It meets all your HUD requirements. It fits within all of the checklist items we talked about in the earlier slide. All that stuff, that would be an existing home. So that's the difference there. So if you ever hear anybody call out the differences to you, is it a new home or is it an existing? Biggest thing is, how old is the home? When was it built in a factory? It was built, let's say it was built in November of 2025. So there you go. It's less than a year old. So in that case, it would still be considered new, even though it's been a few months. It's still considered new because it hasn't been a full year yet. So that's the difference between new and existing. Before I get into some other bullet points here and some other main things about a manufactured home that I want to talk about, I do want to shout out real quick. Fannie and Freddie actually have their own individual manufactured home types. So these are specific homes built to very specific qualifications that only exist for Fannie and Freddie. Fannie calls it the MH Advantage, so Manufactured Home Advantage. So these are homes that have been built with builders that have been previously vetted by Fannie Mae themselves. So Fannie Mae goes out, finds builders, let's say I'll throw a name at like Clayton Homes. They're a big builder across the country. They work with Fannie Mae to build these homes for the MH Advantage that meet significantly higher design standards, stronger construction, and better energy efficiency compared to what would come out not working with Fannie Mae. So if you have a property that was built to the MH Advantage status, you'll actually see this. Here's an example of the sticker right here on the slide. That's a sticker that will be placed on the home to let us know that that home is eligible for MH Advantage. And if a borrower is buying that property, what will happen is that they get additional things. So they can actually go up to higher LTVs. They can go up to 97% on Fannie Mae. They get that 0.50 LLPA waived if it's an MH Advantage. They actually get better MI, and they can combine this with like the Home Ready or any other type of Fannie Mae product. So biggest thing here is that that MH Advantage sticker is required to be placed on the home by the builder in order for the borrower to use those additional benefits that Fannie Mae gives to just only those property types. Now, same principle also works with Freddie Mac. Freddie Mac has the Choice Home, which is the same thing. They have a very specific sticker that has to be on the home. If that sticker is there, then they get some additional benefits there. Of course, it's run through LPA since it's a Freddie Mac only product, and they make sure they have all those different items from there. There's no physical inspection required on a Choice Home. Um, we verify that label was present. That is something that the appraiser would do when they do the appraisal. But you can see here that these homes, both Fannie and Freddie have designed these products in order to make manufactured homes that are built in a factory, but when they're placed on the property, you wouldn't even know they're a manufactured home. They're designed to look at the same as any other traditional site-built home. So that's kind of the biggest thing, but they need to have that sticker placed on there. So I want to call those two products out because those are specific just for Fannie and Freddie before we get into the stuff that applies to everybody. So, like I mentioned, I'm throwing a lot of information out to you guys today for here, but just to recap a little bit before we jump into things. Biggest piece with these is making sure these homes are built after 1976, making sure they're on a permanently affixed foundation. They have never been moved uh, at any point in their life, and that they are required to be fee simple or considered real property where the borrower owns the home and the land combined together on the title. And then of course, you have your Fannie and Freddie products that are specific to them. The next slides that I'm going to go through, these are things that apply to all manufactured homes. So no matter what program you're looking to use, you're using FHA, conventional, VA, USDA. These are things that are going to apply across the board and what the underwriter is always going to be conditioning for. So these are important things to keep in mind. So the first one is going to be your HUD certification label. All manufactured homes that are built after 1976 are required to have these on each individual section. So, for example, we talked about that there's single wides, double wides, triple wides. If it's a double wide, there's going to be two of these on that home. If it's a triple wide, there's going to be three, and so forth. If it's a single wide, obviously one. So it all depends on how many sections there are, will be how many labels. What that label is doing is confirming the home was built after 1976 and making sure it's built to the standards that HUD has put down after that date. If for any reason that plate is missing or it's completely ineligible. For example, here's a slide here from an appraisal. You can see that the HUD plate has been worn away, or in some cases, for one reason or the other, somebody in the past painted over that. When they were doing exterior work on the home, they went through and they completely painted over, so there's no way that anybody could read it. If that happens, which is possible, as you can see from the example here, we would need an IBTS label verification letter. We're going to talk about that a little bit later too. But that IBTS letter will go through and verify that the home was built to HUD standards. So that's a big thing to keep in mind that can add some additional time to your timeline, is that if those label is missing, even if, let's say it's a double wide, we have one label, but the other one is missing or ineligible or in not able to be kind of found in that case, we'd still need a letter because we have one label, but it's a double wide. So we need proof that the second section was actually built to proper standards. So that's the biggest thing. That letter is going to be conditioned for by the underwriter. If it comes back on the appraisal, they can't verify that that specific label is there. Now, on top of that, when these homes are built in the factory, there's a HUD data plate, or it's also called the compliance certificate. This is placed on the inside of the house. So this is actually just like a piece of paper. There's an example here listed. This is filled out by the manufacturer when they built the home originally, and they put it inside somewhere safe in the home. So typically it's inside like an electrical panel, a kitchen cabinet, sometimes in a closet in one of the rooms. What it does is it breaks down the manufacturer model, what year the home was built, any serial numbers, the HUD label numbers, those labels on the outside of the home, make sure they match, the numbers match between the inside and outside of the home, and make sure that the home was built to proper standards for wind, roof load, thermal zones, all that type of stuff. So that's a letter that's in the house. That HUD label on the outside and the HUD data plate on the inside are both required in order to make sure the home meets all standards. So once again, if either one of those are missing, let's say this data plate is missing, somebody ripped it out of the cabinet and never put a new one in, we would need that IBTS letter to verify the home was built to proper standards. All right, so keep moving along here. Just kind of breaks down. You could see Fannie, Freddie, FHA, USDA, VA, all of them require the same thing. So all of these agencies require both the HUD label and the data plate. If one of them is missing, that IBTS verification can be done in order to provide updated information and a duplicate of the missing piece, whether that be the label or the data plate that's on the inside of the home. In both cases, a 1004C, which is the appraisal must verify under all agencies that both the data plates and the panels have been placed onto that home. And if they're missing, the appraiser will call that out, and then we need that IBTS. Now, for FHA, USDA, and VA, there is also the case of an engineer or foundation certification that comes into play just for your government loans. FHA and USDA always require an engineer cert, no matter what. VA only requires that engineer cert if the home has been moved at all. Remember, VA is the only one that allows for a home to be moved one time. But if that home has been moved that one time, we would need an engineer cert for VA. FHA and USDA always needs it, no matter what. That's just a HUD and USDA requirements. All right. So speaking about appraisals, for some basic appraisal things, biggest one here is you want to make sure you're ordering the correct appraisal. For a manufactured home, it's a 1004C. So big one, keep that in mind. Um, Biggest thing I've seen people trip up on, especially if they've never done a manufactured home before, is ordering the wrong appraisal. And then that adds additional, and then the appraiser goes to do the work. They find out it's a manufactured home and they ask for additional money or they ask for additional time. And it adds this extra time to the process, adds extra funds that is out of the borrower's pocket. Make sure that you're ordering the correct appraisal upon the initial submission of that appraisal ordering. So 1004C for all manufactured homes. The appraisal must confirm those HUD labels have been present with photos, that the data plate is there, the home is on a permanent foundation, it's a single unit dwelling, all the utilities have been properly connected, and of course, how many how many sections is it? Single, double, triple, so forth. So the appraiser is responsible for doing all that on the report. Now, when they go in and do that report, if any of these different boxes are checked off no. So for example, is the HUD data plate attached? If they select no, then automatically our underwriter is going to condition for you to order that IBTS report in order for a letter to be provided to us to ensure the home was built to HUD standards. So keep that in case. So this is something that is fixable. Of course, if you see that it's not there, it's not a hard stop that we can't move forward. It's just that it's going to add some additional time to the timeline of your closing because now we got to wait for that letter to come in. So the earlier that you identify that information, the smoother the timeline kind of goes. From a permanent foundation requirement, we've mentioned that a few times already. That can be verified there by a structural engineer or the appraiser in certain cases. Engineer certifications are always required on FHA. FHA requires it on all manufactured homes, no matter the situation. It is also required if these other situations come up, let's say on Fannie and Freddie. So Fannie and Freddie don't require the engineer cert every single time, but let's say that the appraiser noticed that there's been structural modifications made to the home over time, or they noticed that there's been additions attached to the home since it was originally built. Or in the case of VA, the home has been moved one time. So those are cases where the appraiser calls that out in their report. So automatically the underwriter is now going to condition for that engineer certification to be ordered if it is a non-FHA. But keep in mind, if you're doing FHA, you're always going to need it. So keep that in mind as part of your timeline in the beginning. Speaking to that, here's an example of what an engineer cert looks like. Heyman Engineering, they're one of the top in the country. They're available pretty much across the entire United States. I've worked with them a ton over the last 10, 15 years. And they're great for, they're one that I always like to recommend for if you don't know a structural engineer to work with and order these through. But you can see examples of what the appraiser could find that's considered modification or additions, attached garages, decks, porches, overhangs, anything that's structural to the home. The engineer's certification is just proving that the additions and modifications don't make any type of compromise to the structural integrity of the original manufactured home, and making sure the home still remains HUD compliant so that HUD on the back end, once these loans have closed, HUD is not going to kind of come back to everybody and say, hey, this home is not compliant to get financed through FHA. So we want to make sure we have all that upfront with the engineer's cert, and the appraisal kind of calling out anything that the appraiser finds from there. Biggest thing here, if you're looking at a home with a borrower and it looks custom, assume that it's going to need review. So assume kind of going into it, when you look at something that looks kind of off, assume that it's probably going to come up as something that's going to need to be addressed as it goes. As we're still talking about the appraisal, when it comes to the appraisal, a minimum of 2 manufactured home comps must be on there. If the appraiser for some reason cannot find a third comp that is a manufactured home, they can use a site built in that case. Traditionally, we would want all 3 comps to be manufactured homes, but HUD does allow, and all the agencies, I should say, across the board, do allow for the third comp to be site built if, let's say, it's a more rural area that doesn't have as, or there's actually not, maybe not, let's say rural, but there are certain areas of the country that have acceptable manufactured homes, but they're more site built homes in that area of the country. So it's actually harder to find manufactured. That would be was a situation where, okay, that third one can be site built, but the first 2 have to be manufactured homes in order to be acceptable. From a distance guide point, how far away those comps can be all depends on the type of area. So you can see they're urban, suburban, rural. If it's urban, it has to be less than or equal to a mile. And then it goes up to 2 miles for suburban, and it can go as far back as 5 miles away from the subject property if it is a rural. But it does require some additional approval from our management team if you are kind of getting up to that 5+ miles area. So keep that in mind for those rural type of areas of the country. There are areas of the US that do have additional manufactured homes on the same property as the subject property, like an ADU or something like that. I know that's big in California, certain areas of the country. But biggest thing to keep in mind here, this applies across the board, is that if there happens to be an additional manufactured home on the same property, the property that the borrower is going to be living in as their primary residence is the only home that's allowed to be attached to utilities. So, biggest thing here, the additional home, I should say, the additional home on the property must be smaller than the subject property. It can't have its own utilities. It can't have a separate address. It has to meet MPR independently, and it has to be classified as an accessory unit. It cannot be a livable space. The example I've given people in the past when they've asked, okay, I have a borrower, they're buying this manufactured home. There's another manufactured home on the same parcel, on the same piece of land. What do we do with that? That additional uh, structure has to be used, let's say, like a storage shed. It has to basically have no utilities. It can't be livable. Nobody can live in that home, that structure. It can't have the ability for somebody to go and live in there. Only the subject property can be livable on that particular parcel. So biggest thing there is that the appraiser must also value no assigned value to that additional unit. It's just an accessory unit. It's just the same as like a shed in the backyard. So it still meets eligibility, but it can't have any comp support, no value, if there is an additional manufactured home on the property. So keep that in mind. Here's that IBTS I keep mentioning. Here's an example of one here on the slide. This IBTS is your backup plan in case those HUD labels or the data plate are completely missing or not legible when it comes to the appraisal and what they can see on the report. So what it does is that the IBTS will actually provide you with a HUD label verification letter or a duplicate data plate / performance certificate. So once again, this is used if anything is missing, unreadable. You would order through IBTS's website, and they would post on their website their current turn times that may vary, and they will then provide you with that letter or certificate within what their currently posted turn times are, and that will fit within the condition that our underwriter is going to put in there to verify the home was built to HUD standards. So, like I mentioned, if it comes into play, if we're missing the data plate, the labels, it's going to add additional time to your timeline. Keep that in the back of your mind that that could be a possibility if you haven't already kind of looked at the home and seen that something was missing. But then you have it covered here. So you don't have to worry. It's not a hard stop. It's just going to add some additional time. Here's that engineer certification, as I mentioned earlier, just another example there. This is going to be broken down here. The certification does need to state that there are no visual evidence that the home has ever been previously installed at any other location. That if there are any improvements, additions, modifications, that they do not negatively affect the structure, and they all still meet HUD standards. The cost of the engineer certification must always be properly disclosed to the borrower. So remember, is that on FHA, we're always going to ask for that engineer cert. So FHA loans, you're always going to have that on your initial loan estimate. When it comes to Fannie, Freddie, USDA, VA, those are cases that it all depends on what the appraiser comes back to. So you might think, oh, I don't need an engineer cert in that case. What will happen here is that then later on, maybe the appraisal comes back and it's determined, yeah, we do need it. Then in that case, that is something that will need to be a new and updated disclosure, a revised LE that our team can help you with. And that revised loan estimate will go out to the borrower, adding the additional cost for that engineer cert now that it has been required. But FHA will always be there up front. So biggest thing here is always make sure you're setting expectations properly with your borrowers, with your realtors up front, because those engineer certs can take time. So it all depends. There's not a set timeline I can say for how long they take. It all depends on the location of where in the country, the type of property, the size of property, I should say, all these different types of factors, when the availability of the engineer to go out and actually inspect the property, all those types of factors can go into how long it could take, but it will add that additional time. This just breaks down again when an engineer cert is required. You can see there that it's always required on FHA. The only exception to that, so there are some exceptions. The only exception to that is if it's a REO sale. So what that means is that the home is being sold by HUD themselves. So if you're buying the home from HUD, you don't need the engineer cert because HUD themselves are the ones who are actually selling it on their HUD marketplace. But if it is a home from anywhere else, then you still need it. Um, the if it's an FHA to FHA refi, you can use the original. If it's a VA to VA refi, that's actually perfectly fine as well. Um, but the VA to VA one is only if the original engineer cert is provided. So if we have the original engineer cert, there's been no additions, no modifications made to the home, you can still move forward. You don't need a whole brand new engineer cert in that case. And then the rest of the agencies are all strictly based on if the home has had any work done to it. So if the appraiser determines that there's been work done to the home since it was originally built, automatically you're going to get that engineer cert condition placed there on your underwriting approval. Um, Big thing, always make sure additions and modifications can make a house ineligible for FHA. So always check that stuff up front. It must meet all your HUD standards and local building codes. Large additions must be permitted. It must have special permission from HUD when they originally built it. Biggest thing here is FHA/HUD is the most sensitive to structural changes. They're the ones that's going to be the most strict and the most kind of really specific to that if it's determined that there was work done to the home. So keep that in mind. All right. And double check there. You can see there, you compare the GLA to your tax record. If there's any type of mismatches throughout the life of that property, there's going to be some additional proof needed. So we need like zoning letters or copies of permits. Those can cause some additional red flags to pop up. Other pieces I want to call out if a home is located in a flood zone. Um, if it is in a flood zone, you would need an elevation certificate. That elevation certificate will determine as long that all the proper structures are above the base flood level. So you have your base flood elevation. That property, those main structures would need to be above the base flood elevation in order to make sure the home is eligible for financing. So elevation certs are not required on conventional and VA, but FHA and USDA do require those elevation certs if the property is in a flood zone. The only way to get out of the elevation cert is if FEMA does a reevaluation of their flood maps and they remove that subject property from the flood map. So that's what that LOMA or LOMR is. That's the flood map that FEMA draws up for the country on what areas are considered flood zones. So if they change that and the property is longer located in it, you're fine. You don't need the elevation cert. But if they don't change it, then you need the elevation cert to get financing if it's in a flood zone. Flood insurance must be included in the borrower's DTI, and the flood insurance will be escrowed as well if that's applicable. Some title requirements here, just to keep in mind, you do need the Alta 7 and the affixation affidavit. This is to confirm that the home is considered fee simple, real property, and the home has been attached to a permanent foundation that will not be moved. So those are things to call out there. If you do any business in the state of Texas, you would also need a T31 endorsement for manufactured homes. So those are just things to keep in mind when it comes to working with your title companies to make sure you have the proper title documents on all your manufactured homes that you're working on. So, like Texas is the only state that does something a little bit different for those endorsements, but otherwise, that Alta 7 and the affixation affidavit are going to be your main two title documents that are needed on all manufactured homes when you're working with your title companies. So, like I said, I threw a ton of information at you on this presentation today. I know jumping through a lot of it super quick to give you just kind of a base level of the most important things when it comes to working with a manufactured home. I have a couple frequently asked questions here on this final slide, just to kind of speed around through the rest of these. We talked about there at the top, it's just a rehash of what is considered to be a manufactured home. Biggest one, it's built on or after the 15th of June of 1976 on a permanent foundation, considered year-round living and built to HUD standards. Um, are there any manufactured homes in parks or lease states of eligible? No. The home must be situated on a fee simple borrower-owned land. So it cannot be in a mobile home park. It can't be in a leasehold in order to proceed. Can a manufactured home been moved or traded? The only exception to that is VA. So all agencies do not allow for a home that has been moved from the original location, except for VA, which allows you to move it one time. Um, for the appraisal, um, they have it needs to be a 1004C. So the 1004C is the manufactured home specific report. Make sure you're ordering the correct report when you go and order your appraisal report. Are cash out refinances allowed? They are allowed on conventional and VA. So FHA and USDA do not allow for cash out on manufactured homes, but conventional and VA does. VA has some more additional restrictions and guidance in their handbook that goes into that. And biggest question here, how can I ensure a smooth manufactured home closing? The smoothest way to get to a closing on a manufactured home, confirm your eligibility before you take an application with your borrower. Collect that HUD documentation as early as possible. Make sure you're ordering the correct appraisal, that 1004C, and make sure you're reviewing your foundation and title requirements up front because it may change for the state that you're working in. It may change all those different things. So doing those basic things, of course, I showed you guys a lot of other information to know, but those basic things will make the process significantly smoother when it comes to working with a manufactured home to the point that once you're really used to it and you're kind of getting a flow with it, these are types of homes that will be no different than any other type of property that you're used to working with right now. And that way, our motto here at MLB is making lives better. And the great thing about this product is having this available allows you to bring that out to the partners, your realtors, your borrowers, and being out there to offer them not just your straightforward site built home, but now you can help those borrowers that have this type of property and know, okay, we can make this process as smooth as any other type of property because we know what we're looking for. So in those cases, that is what I have for you guys today. I saw some questions come in the box here, but if anybody else has any other questions, feel free to throw those into the chat box. But I'm going to circle back around to what is in here. So I saw a couple questions about the actual slide deck that I'm using today. So it is currently available right now. If you go to mlbwholesale.com, we do have a products page where we post all of our presentations. The one I use today, plus, of course, presentations for all our other specialty products as well. You can go on there and download those presentations from our website as well whenever you have a chance. I saw a question come in. Are they considering changing the law for HUD approved from 1976? So the answer to that is not to any of my knowledge. I They have been pretty hard and fast on that 76 rule for as long as for as long as I've been in the industry. I've been in the industry about almost 20 years now. So it's been hard and fast to that 1976 date ever since. Thank you. There we go. And our marketing team actually just dropped a link to those presentations directly in the chat here as well. So you guys can grab that link and save it. And like I mentioned, we post all of our videos and presentations on that link. So as we introduce new products and updated versions of our presentations, we have that available for you guys whenever you need it. So in those cases, the other thing I want to point out, if you have any manufactured home scenarios you'd like to run past us, reach out to your assigned account executive. They can help you out. But also, we have our scenarios desk. It's just scenarios at mlbmortgage.com. And that will go to our team and they can take a look at your scenarios and get back to you as soon as possible with additional information, additional questions that they have to point you in the right direction. Of course, give you that clarification, that confidence to move forward with anything that may come across your desk. So if you have any other questions, I'll give it just another minute or so if anybody else wants to type a question in, or you can feel free to unmute yourself as well if you feel comfortable. I'll stick around and answer any of those. But if not, I want to thank you all again for taking some time out of your day. Let's see here. So for that link, we'll double check. Our team will double check on making sure all the correct things are, but everything will be on that link when it comes to the actual slide decks for this and other stuff. But once we jump off this call, we'll double check and make sure everything looks good there on the proper stuff. So give us a moment. If it doesn't show right this moment, give us a moment and we'll make sure we'll get that all updated for you guys. All right. All right. Thank you so much, everyone. Have a wonderful rest of your day, a wonderful rest of your week. Thank you for being a partner with MLB and helping us make lives better. Have a wonderful rest of your day.